Good morning, ladies and gentlemen. Welcome back to Top Stocks. This is a show where we suggest quality picks to you as far as this downturn is concerned, something that you can take advantage of and create a long-term portfolio which will generate supernormal returns compared with the rest of the market, because you are buying pain, you are buying quality, and you will be rewarded in the medium to long term. Today's thesis is on the mid-cap sector. Remember, this space is not an opportunity or an invitation to buy or sell these stocks or funds. This is just an information that we are providing. Of course, you will have to consult an independent financial advisor and an independent mutual fund advisor should you want to take positions in such stocks or such schemes. As usual, I have zero financial interest in advertising or talking about this stock or fund. Today's story is based on Kotak Emerging Equity Fund. This is a mid-cap scheme. The fund was set up in March 2007. So that's 13 plus 5, 18 years of performance that we have in front of us. As I have said, it's a mid-cap fund and it provides you an opportunity to buy as much as 66 stocks at a net asset value of 128.78 rupees per unit. Remember, the all-time high for this fund was somewhere like 154, 155 rupees, which was somewhere in early October, and from then on till now, the fund has corrected somewhere like 18% in prices alone. Why does a mid-cap fund make sense at current levels? Well, one, you have to have an investment period of about 5 to 7 years. So that's a given. Mid caps over time have outperformed large caps and to some extent even small caps if they are held for a period of more than 5 to 7 years. So mid cap funds are an essential component of your wealth creation strategy, which will include large cap, mid cap, small cap funds. How should be the percentage? Well, anywhere between 15 to 20% of your mutual fund portfolio should be in one or two mutual funds which deal with mid caps. We are discussing Kotak Emerging Equity Fund. The assets under management for Kotak Emerging Equity Fund is 49,000 crores. This is amongst the top 2 or 3 funds when it comes to the size of the AUM in the mid cap space. As I have said earlier, it was launched in March 2007 and returns since launch have been to the extent of 14.3%, 14.4% compounded over a period of 18 years. If you look at the last 10-year performance, a 10,000 rupees SIP, which would have totaled 12 lakh rupees in investment spread over 10 years, is now 32.66 lakh rupees. Remember, we've already seen a correction, so if it was at 158, the amount would have been far higher. In the last 10 years, Kotak Emerging Equity Fund has compounded at 19% each year. Yes, mid caps and mid cap funds are volatile, but the beauty is that if you continue holding, and more importantly, if you are in a process of buying the dip, this fund or any fund for that matter gives you supernormal returns, because you are buying pain and you are buying quality available at a lower price. Now let's look at the top 10 holdings that constitute about 28% of Kotak Emerging Equities portfolio. They are in the tech space, Mphasis. The fund is heavy on healthcare. You have IPCA Laboratories, which is India's and the world's largest maker of anti-malarial drugs. There is Fortis Health, the hospital chain, about 3.2% of the portfolio. From the real estate space, you have Oberoi Realty, which is Mumbai's biggest realty company. Oracle Financials from the mid-cap IT space is the 5th largest stock in terms of AUM as far as Kotak Emerging Equity Fund is concerned. Let's dip a little lower amongst the top 10. Fertilizer maker Coromandel International. Persistent Systems, again from the mid-cap IT space. Cement is represented by JK Cement, and of course you have Wipro. The other stocks in this portfolio are Dixon Technologies, Power FinCorp, Schaeffler India, PI Industries, Supreme Agrochem, Birla Soft, Bharat Electronics, Deepak Nitrite, to name just a few. Now let us look at the return portfolio of Kotak Emerging Equity. I'll also give you sector-wise holdings. Kotak Emerging Equity is overweight in the materials sector. 17.4% of overall assets of Kotak Emerging Equity are invested in the materials segment versus 11.3%, which are the category average. Industrials are underweight, 17.3 versus category of 18.4. Technology is overweight. As I have mentioned, amongst the top holdings, the biggest is Mphasis, followed by Oracle Finance, and then of course you have Persistent, Wipro, and lower down you have many other tech counters. It's underweight in consumer discretionary. It's also underweight in financials. 11.4% of Kotak Emerging Equities AUM is into financials versus 17.4. What is really interesting is that you don't see a single bank in the top 10 holdings of Kotak Emerging Equity. So that's a welcome change. Overall, the portfolio price to book of Kotak Midcap scheme is 4.69 and the portfolio PE is 31.8. Now let's shift our focus to returns. As I have said, over the last 10 years, the fund has compounded at a rate of 19% each year. But let me just give you some more data. Yes, the last 6 to 8 months have been very painful. It is at the bottom quartile of about 44 funds that have a 6-month history. So 44 mid-cap funds. So in the last 6 months, Kotak Emerging Equity has fallen 16%. The mid-cap index has fallen 17%. This is no comfort. It has still underperformed. It has still outperformed the mid-cap index, but yet it has fallen 16%. The beauty is when you look at performances beyond 1 year and 1 year alone. In a period of 3 years or 5 years, 5 is interesting. The fund, as I have told you, is appreciated 25%. It ranks 12th amongst 24 funds. Over a period of 10 years, it has a third rank compared with 19 funds in this category. So the short term has been painful. It has been volatile, just as is the case in many mid-cap funds. But the longer term, as you see, it gives you superb quality. If your fund is compounding at 17%, ladies and gentlemen, every year for the last 10 years, it's a fantastic return when it gets compounded. In the last, because it was set up in March 2007, that makes it 13 plus 5, 18 years. For 18 years, each year, no matter what the volatility, the fund has given an average compounded return of about 14.4%. This is the quality that you need to buy in your portfolio. Buy in a SIP method. You can also do in a lump sum, but remain invested, ride this volatility, and remember, mid caps over the long term create more wealth than large caps. Leave it to the fund manager to buy top quality mid caps for you. Leave it to him to manage local volatility on a daily basis. Leave it to him to take buy and sell decisions. All that you do have to do is to buy quality at a certain point of time and then start investing it in a monthly format. Again, as I have said, this is not an invitation to buy Kotak Emerging Equity Fund. This is an overall study of the fund. You need to consult a mutual fund advisor should you want to take a position in this. But remember, if there is something that has appreciated over 18 years at a rate of about 15%, this is something that should be a part of your long-term portfolio for wealth creation. Thank you for watching. I'll be back at 2 p.m. Good morning, ladies and gentlemen. Welcome to a fresh week where we discuss quality stocks and quality funds. We'll start with the Nifty, ladies and gentlemen. The Nifty is on